Hello everybody and welcome to the Cyclical Investors Club YouTube channel. As always, this isn't investment advice. This is just for educational purposes. Today I'm going to be looking at Advance Auto Parts stock and going through an article that I recently wrote on it and seeing where we think the stock might be in 4 years. So let's go to the article. I'll be using the same earnings valuation technique that I have been using in the last few videos here. And basically what we're going to try to do is predict or estimate where the stock might be about 4 years from now if the previous trends continue in roughly the same direction. There is a bit of a twist with this one that we'll get to at the end. So I think there's a little bit of a lesson potentially. I mean, we'll see how it turns out to learn. So I actually bought AutoZone during the March 2020 crash, right near the bottom of that crash. And I remember O'Reilly, which is another auto parts retailer, they were just the stock was like pennies away from being a buy. So I actually got AutoZone and I missed picking up O'Reilly's right at the bottom. Like it's the next stock I would have bought if J Powell would have came out one day later, I probably would have bought O'Reilly as well because it would have fallen just a little bit more. But that's the way that it goes sometimes. Interestingly, I don't remember, I mean, it might have been kind of close to, but I don't remember Advance Auto Parts being close to a buy the way that I remember O'Reilly being. So whatever metrics, I was using a similar type of valuation process that I'm going to share here. But for whatever reason, I was requiring a lower price than Advance Auto Parts fell during that time. So I thought that was interesting. So I opened up the article by looking at the returns. So I've done really well with the AutoZone. I still own it. It's up over 200%, which is good. But if you look, Advance Auto Parts is this orange line here, and it actually recovered more quickly and strongly coming out of the March bottom, which 320 is one day before the March bottom. So this was almost right at the bottom. But then, similar to a lot of the pandemic-related boom stocks, it wasn't clear that Advance Auto Parts was one of those, but about the same time those stocks started rolling over and going down, so did Advance Auto Parts. So for the past year, this stock is down a lot, whereas its competitors and similar businesses, both O'Reilly, which I don't own, and AutoZone, which I do own, are performing really well still and basically similarly. So that's kind of interesting to look at. Now, so far, at least a few days ago when I put this article out, Advance Auto Parts was still outperforming the S&P 500 if purchased on the same date. But as you can see, it's very quickly converging with this similar performance. So I thought that was interesting to note. This type of thing is worth paying attention to when you have businesses that are so similar, right? And then we even have more than just one to compare. We have a set of three, and then also the wider market. So there's a little something going on here that should make you at least want to investigate a little bit more, try to see kind of what's going on. So after this, I get into my normal valuation process. So the first thing that I check is the historical earnings cyclicality. And when we look at Advance Auto Parts, I'll just pull up the actual fast graph that's live here. So when we look at their history, we see actually that they grew earnings through the Great Recession, which is pretty impressive. Some of that makes sense because if a person doesn't have money, as someone who lived through the Great Recession, if you don't have very much money and you need to you can't afford to buy a new car, or your credit score doesn't let you go buy a new car because you just are behind on your bills and somebody lost their job, when you're going through that kind of thing, or you're behind on your mortgage payment, which a lot of people were, then you're more likely to repair your old car than you are to go buy a new car, right, or a newer car. And I mean, if you recall, I mean, automakers were going bankrupt, right? So it was a serious downturn there, and a lot of people were just fixing up their old cars, and that kind of explains how they could do this. But it's still pretty impressive that they managed to continue to grow their earnings per share through the Great Recession. Okay, now what I find interesting is this dip here. Let's shorten the fast graph so we can get a yearly breakdown here. So we have a 9% decline in earnings growth and followed by a 25% decline. So when you add these together, I would consider that a moderate earnings growth decline. It's not more than 50%. So we can still use an earnings-based analysis to analyze this stock, but we want to make sure that we account for these, this sort of decline. But whenever I see something like this, I immediately check to see what their acquisition history is, right? So if you go and look on Seeking Alpha, which is what I did to see if that explained what was going on. Now, typically what happens with acquisitions, so they bought General Parts Company in late 2013 is when it was announced for $2 billion. So they were about a $6 billion market cap at the time, Advanced Auto Parts was. So this is about a third or 35% of their market cap. I would consider that a very big acquisition. And my rule of thumb is to wait 3 to 4 years after something like this is announced or goes through before I consider buying a stock, because management almost always overpays, and even if they don't overpay, it can still take a few years for the benefits of a acquisition or a merger to really come through. And usually the pattern is they're slowing growth at the business, whatever the acquirer's business is. So they want to go out and buy something to help them grow because they aren't growing what they perceive as fast enough. Maybe they're even starting to shrink without that acquisition. So they feel pressure to go out and buy something to boost revenue, especially, and then usually they can, for when it comes to adjusted earnings, which is what I usually use, they can have like goodwill and things like that, where they say, well, the company we bought is worth so much. But after 3 or 4 years, usually what you see is the company is not worth what they paid for it, and then they write that down, and the earnings get adjusted back to where they probably should be, and we get to see kind of the truth of the matter after we've had some time. So rather than try to investigate each business and really dig down into it, which a person can do, I just don't buy stocks that make big acquisitions, generally speaking. There are 2 exceptions that I would say. One of them are banks. If you have a standard regional bank, they're so similar usually that if you have a bank that's a little bit more efficient and they buy another bank or merge with another bank, there genuinely are pretty easy efficiencies that they can get out of that. And so I don't count that against banks. Usually it actually works out pretty decent for them, as long as they're not like just crazy acquirers. So banks are an exception. Also, mergers of equals that are like all stock deals. I mean, they'll have to pay fees and things like that in order to usually do these mergers, and it costs them money. But they aren't nearly as, it's not really like one company really overpaying for another company, which is what you want to avoid. So usually the merger of equals, the bigger danger is that the reason they're merging is because growth is slowing generally in the market of whatever that they do. So they want to consolidate and have more pricing power. So that's kind of a sign that growth is probably going to be slowing, and it's not great, but it's not like a complete, don't buy. So I would have avoided advanced auto parts for at least 3 years. 3 years is my basic standard. It probably should be about 4, I've noticed. It depends on when it's announced, when it closes. There's a lot of things. So it's just a general rule, but 3 to 4 years is generally what I look at. Now, if the stock sells off a lot in year 3, then you can kind of look at it and say, okay, now we're getting this priced in. So that, in my opinion, explains the weird timing of this decline here. And if you look, the story is sort of in the numbers. You have these guys are growing essentially double digits. This is averaging 20% growth. And then in 2012, they go to 2%, right? So it's like, okay, that's 1 year, but the next year it's still single digits at 9%. And they're probably, I didn't check buybacks this far back, but they're probably buying back stock too. So it's probably actually a little slower than this in terms of actual not inflated earnings. So these are the conditions under which you would say, management would say, okay, we need to get back to this 20% growth because that's what our investors expect, and maybe we should go out and buy something. And then you see that they get rewarded here with this gigantic bump, right? So this is the short-term stuff that you need to pay attention to. And these are general rules. I haven't done deep research, but when you see these patterns enough, you just learn, okay, this is the pattern that I 90% of the time would find on a big a company this size making a big acquisition. So, but what happens is once earnings come back to reality here, when the real earnings get reported or whatever, you see that if you averaged all these out, you really were probably back on this single digit trend, right? Maybe they're growing 9 or 10% instead of 20. So this was kind of an anomaly, and that's why you would want not to. And let's look. So they announce around here, and the initial reaction of the stock is to go from 82 up to 100, almost $200 a share. So management succeeded for 2 years here to convince investors that this was a great deal, probably while they're selling. I haven't looked. Maybe they didn't sell shares, but it's not uncommon to have management selling shares during this time that are part of just their regular payment, and that's normally what you would see. And then what happens is in year 3, so we have year 1, year 2, everything looks great, and then in year 3 we get some signs that things might not be great, right? And we get a little bit of a decline. And then in year 4, in this case, this was the very end of 3, so 1, 2, 3. So in the middle of year 4, we get kind of the truth year, and the price comes down. So if you measure it from the time of the announcement roughly to this bottom, you're flat, or negative actually, a little bit, over 4 years. So this is just the type of thing that you just, every now and then management will really nail an acquisition and it will turn out to be great. My rough estimate of that happening is about 1 in 10, right? So if you want to do deep work and look into it, but I just don't believe anything, don't believe any of the projections, don't believe any, I don't even listen to it, right? I just think of it for it myself. Every now and then something kind of works out okay. Most of the time it looks exactly like this. This is quintessential right here. So that might be one of the biggest lessons from this stock. But let's keep going. So that was in the past. We kind of see it with the revenue too. So this is the acquisition, and then revenue declines a little bit. Once they get everything kind of worked out, it starts to recover a little bit, and then this is pandemic boom, and then flat after that. So it's pretty much exactly what I would have expected to see from just by looking at that initial chart. This is exactly what I would have expected was the cause. It's not always. Sometimes there's there's other reasons, but usually it's also going to be a reason why I wouldn't buy. So, but this is all behind us now, and I'm going to take that decline into account. Now, after starting in 2019, they started buying back shares. So the numbers we see, EPS numbers, are inflated because shares are being reduced. So they bought back almost 20% of the company. I will say that AutoZone and O'Reilly have bought back even more stock during this time. So when I compare them and I look at them, I actually adjust their earnings growth estimate down even more than I do for Advance Auto Parts. However, Advance Auto Parts has earnings declines that AutoZone and O'Reilly don't. So let's actually look at that real quick. So we see this decline that they have here. If we look at AutoZone, maybe if I get it to load. It's trying. So it's perfectly flat in a straight line. And part of this is because they buy back a lot of stock. So it's probably not quite as pretty in reality, but the fact is there's no dips and it just goes up every year. And it's been a while since I looked at O'Reilly, but let's take a look at it as well. Very similar, right? None of these giant drawdowns. I think up almost every year. They did fall slightly during the Great Recession, and that's it. Okay? So we can kind of see the difference between the different businesses here. Now, and O'Reilly again buys back a lot, so when I adjust for that, earnings won't be quite as steep as they look. Earnings growth wouldn't be quite as steep, but it's still much better because they didn't have these years where they were declining that I actually take into account. So when I take into account this year drop, and when I take into account the expected drop this year in 2023, which is expected to decline 14%, this is even lower now since as I was working on the article. So it just keeps coming. Every day I look, it's lower. So now it's 1089, and it was supposed to decline 14%, I think, when I wrote this article, which I actually adjusted once while I was writing it. It was $11.24. So every day an analyst is getting more bearish on their prospects of earning money this year. That's kind of a warning sign when the similar competitors are not experiencing that expectation. So when I put all this together, I get an earnings growth rate of 1.66% from 2015 to 2023. At the time I wrote the article a couple days ago, the PE ratio was 1232, which is, let's see, based on this $11.24. So I think the price has probably fallen with these earnings expectations coming down over the last 2 days. So we're probably at a similar valuation when it's all said and done. But that produces an earnings yield of, if you just invert the PE ratio, so earnings over price, that produces an earnings yield of 8.12%. So the way I think about this is, if I bought this business at this valuation for $100, it would pay me, if I was the owner and I kept all the earnings for myself, it would pay me $8.12 per year. And then those earnings would grow, that amount, that $8.12 would grow at 1.66% per year. And then what I want to figure out is, how much money would I collect over 10 years if with this starting point and growth rate, right? And so I put that all in a table here, and if you add it all up, this is as it accumulates, and this is per year. If you start with $100, and it would add $88.95 over 10 years, so it would grow to $188, almost $189. If you put this in a Kegger calculator over 10 years, you get a 6.5% Kegger. That's what I would expect per year if the pattern since 2015 continues for the next 4 years, and then we kind of expect that to keep going for another 6 years. So you can take that and just do it over 4 years, and you get 28.9, so almost 29%. That's about what you'd expect to earn over the course of 4 years if things stay the same or similar as they have been recently. As we saw with this stock, there's a lot of noise there. Now, in addition to the drawdown period that they had in earnings, we also had corporate tax cuts in 2008. We had massive stimulus in 2020 and 2021. So those probably boost earnings quite a bit during this time too. So there are some down things that we're taking into account, and then there's up positive things that happened that probably won't happen again that also took, but I didn't control for the positive things. So if anything, I think I'm probably being optimistic, which I get into here later. So that's the basic return over 4 years that you would estimate, right? So, but I want to compare that to what it is to the S&P 500 or cash. So T-flow is my cash. What I'm using for my investment cash right now is the ETF T-flow. I expect it to distribute about 4% per year. Right now, I think it's like 4%, but just average over 4 years, collect about 17% from cash. So we want to compare that to Advanced Auto Parts expectations, and then for the S&P 500, I expect it to return about 27%. So when you consider these are 4-year returns, just looking at the basic return, it basically looks like it's fairly valued and going to return similar to cash, similar to S&P 500. It doesn't look overvalued or undervalued. Pretty much right where you would expect it based on the numbers that we looked at. So now that can be eye-opening to some investors who are just looking at a PE of 12, and they say, well, they have a PE of 12 and the S&P 500 has a PE of 18 or 19 or 20. It looks much cheaper, but the S&P 500's earnings are growing more than Advanced Auto Parts. So they should have a higher multiple, right? So that's what all these calculations and stuff that I'm doing are taking into account. And then it's trying to kind of give them to you on an equal basis here. So now the next question is, well, what happens, maybe the S&P 500 is a little overvalued, which it is, I think. What happens if it reverts to just its kind of long time average of what the market usually likes to kind of gravitate toward, which is about 7% earnings CAGR per year. Right now, it's in the 6.3% area. And so in order for it to get to 7%, the price needs to actually come down. And the same is similar. Well, it has a very similar expectation at 6.59%. So in order to get that up to 7, the price actually has to come down because there's an inverse relationship, and the PE needs to come down. So in order to get the PE down, if everything else stays the same, the price needs to come down. So if that happens and everything reverts to what it kind of normally likes to trade at, then the expected return drops to about 20%. That's a little better than the S&P 500 of 14. Again, right in line with like cash, and these are almost, considering these are 4 years, so divide these by like 4, that's less than 1%, a little over 1% difference per year. To me, these are just all estimates, so we're just trying to get a ballpark. All looks valued the same to me, so I don't see anything high or low about it really, based on just the numbers from 2015 through the expectation for this year. All right, so now we get into I just explain a lot of the valuation stuff, which I do in most of my articles now. Now, what I get in here is, so when I have a basic valuation method, which I share in all these articles, but I have a lot of other factors that matter to me as well, and I don't usually write about them unless they're relevant to that particular stock, because then my articles will be really, really long. Each one would be like a book. So if nothing comes up then I just share the basic valuation analysis. In this case, when we expect earnings to only grow at 1.66% per year, my long-term assumption always is that inflation will average about 3% long-term. So 1.66% is it's not negative, right? So it's still positive, but it's below the what I would expect inflation to be, and it's also trending down quickly. So if I redid this analysis again today, maybe it'd only be 1.5 because analysts are expecting earnings to actually fall deeper than they did a couple days ago. So you can see that the trend of earnings for this year is down. The long-term earnings growth is just barely positive and below inflation. And so when I see something like that, this would be, if I already owned it, it would kind of be borderline in my portfolio. I'd have to make a judgment call on whether I wanted to hang on to it or not. But in the past year, when I didn't own this one, but I have similar stocks that just kind of underperformed. You look at their growth, it's not kind of doing what I had expected it to when I bought them like 3 years ago. I went through and sold most of those. So if I had bought this stock and it was in my portfolio, even though the valuation is a hold, it's basically like market neutral. Given that earnings are deteriorating, given that they appear to not be competing well with their other public alternatives, I mean, I'm long AutoZone, but I mean, I think O'Reilly is similar, so I don't see any reason why a person would own Advanced Auto Parts stock when once earnings growth is taken into consideration, O'Reilly and AutoZone are valued similarly. I mean, they're both kind of valued the same as the market right now, but the quality of the direction of earnings is going up instead of going sideways to down. So that tells you that Advanced Auto Parts probably isn't the highest quality here, and they're all are similarly valued alternatives that a person could just buy. And so for that reason, I would rate Advanced Auto Parts as sell, even though the valuation says hold. And that's due to the slow expected earnings growth and the danger that could go negative, which not just negative for like a year, which isn't a big deal if they recover. A lot of times I'll buy stock when earnings are kind of down for a year because people freak out and sell it cheaper, right? If I think it's going to bounce back. But I don't see a lot of evidence here that it's going to bounce back any better than O'Reilly or AutoZone. So to me, this is a pretty easy sell. It's a pretty this is where it can make a difference between an investor who kind of knows a little bit more than just the basic PE and maybe the dividend. Some people I don't usually buy stocks for the dividend, but if we look, I don't know what the dividend yield is. So here's the thing. Somebody's looking at it and they're like, oh, it's a 4.3% dividend. Well, cash is 4.6 on T-Flow right now. So it's not paying you any more than that, but you have the risk of the stock price going much lower. So to me, whereas AutoZone doesn't pay a dividend, okay? So at all. And so this is the thing where people who are looking at the dividend, people who are just looking at the PE ratio without taking in growth into consideration, where they could be slow to sell this stock and it would give the more seasoned investor a chance to sell before the stock really struggles, like a 3M or there are periods where, look, a reasonable investor could have held that stock, but there's a point where if a person's really thinking about it a little on the second level thinking, they have time to get out of that before the real deep declines come. So, and this I kind of feel a similar way. The stock price has returned almost nothing for 7 years. That's indicative of a 1.66% earnings growth. So I think that's it. And I will have a link to this article down in the description. I'll have a link to the Cyclical Investors Club. It's $30 a month, and then I have spreadsheets and everything that track hundreds of stocks, so you can keep up to date on all these valuations like really quickly, and you can hopefully get the higher quality ones like AutoZone, and the more marginal ones we try to avoid. And I'll talk to everybody in the next video. Later.